Hello, this is Jordan, and this video is being recorded on Wednesday afternoon, June 15th, 2022. Thank you so much for joining me today. Make sure you like, comment, and subscribe. I would really appreciate it. And in this video, I am going to talk about the best leading indicator for gold and something else. And first is that something else. And that is the chart of gold and also a chart of the real 10-year yield. And this is a chart I saw on Twitter by Chris Rutherglen. I hope I'm pronouncing that right. If not, I apologize. Follow him. He's got some great charts, very nice looking charts. And you can see I retweeted this, so that's an easy way to follow him. But speaking of leading indicators, what's really interesting is how the gold price tends to lead real yields. I mean, as you can see, they track each other over time, but at certain points, the gold price diverges a little bit. And so it's a question of, well, are we going to follow real yields or are we going to follow the gold price? And usually you want to follow the gold price. And this chart, I want to start with 2005, 2006, because this chart doesn't show that, but that was a period where real interest rates were actually rising and gold had this major breakout in late 2005. So that was one instance where the gold price was right and the gold price was leading by quite a lot. And so here are a couple more examples. Look at the arrows. Look at when the gold price peaked. We know it peaked in 2011. Well, real yields actually... this is an inverted chart of real yields. So real yields actually bottomed. They made a lower low after the gold price peaked in 2011. So based on real yields, gold should have peaked in 2012. I mean, it made that secondary peak then, but it peaked at 1800 versus 1900. But you can see there was a divergence there. The gold price in the end was correct. Same thing happened at the bear market bottom. At the end of 2015, that's where the second arrow is. And you can see that if you look at the blue line, you can see that real yields actually made a lower low. So we're looking at, this is in, I think, towards the end of 2018. So after summer, you can see the blue line there. That made about a 7+ year low at that point. You can see it made a lower low versus where it was in 2015, 2016. However, the gold price did not make a lower low. The gold price, its low was at the tail end of 2015. So another example of where the gold price was right in the end. And I think we're about to see another instance of the gold price being right. And if you look recently, it's pretty obvious here. Real yields have been surging higher in recent months. I mean, since the beginning of the year, really since November of last year, but especially in the last 3 or 4 months or so. And look at gold. Yes, gold has come down. Of course, gold is not going to completely buck the trend when you have real yields surging. So gold has come down, but gold isn't even close to making a lower low. And look at real yields, how deeply, based on this chart, I mean, how much lower they've gone. Remember, it's inverted. So based on that, the gold price is holding up really well. And so that's a signal that ultimately real yields are probably going to go the other way and gold's going to eventually break out. Doesn't mean it's going to happen next week, next month, or next quarter, but I believe that's what's coming. Based on all this analysis. I also forgot, another thing to look at is real yields actually bottomed. I like to look at the 5-year. This shows the 10-year here, but shorter term real yields, like the 5-year, for example, they bottomed in, I believe, March of 2021. So gold peaked, 5, 6, 7 months before real yields bottomed. So gold should have kept running. that's one fundamental complaint we can make. Gold peaked way too soon based on how low real yields were going. And then they finally made that bottom a little more than a year ago. And of course, recently they've come down significantly. But again, the point is the gold price has been right at that point, or it was at that point, because the gold price was correcting, even though real yields had not bottomed yet. And, fast forward to now, more recently, again, we're seeing the opposite, where gold should be going a lot lower, but it's not. So that's a very good signal for gold. I know it doesn't necessarily help anything this month or next month. I mean, silver and the miners and the junior, they're really weak, but they all play off of gold, and they will move hugely and massively when gold breaks out. So that's why we have to be focused with gold. And this is just a really good sign. I mean, in the face of really strong real yields, of course, the dollar as well, gold is holding up pretty well. It's holding up much better than it normally does. That bodes really well, I think, especially for, call it 6 to 12 months, 4 to 9 months, something like that. Now, I should have put this one first, but the leading indicators I like to look at are gold against foreign currencies, gold against the stock market. So here we have gold against the stock market. This is a weekly line chart. We have gold at the top. We have gold against the S&P 500. Folks, the gold against the S&P 500 is an important leading indicator for gold. It has turned and strengthened. It has a history of doing that before gold does. We're seeing that happen again. Look at the bottom right of the chart, bottom right corner, the yellow circle there. Gold and S&P 500, that ratio's bottomed. It's been rising for more than a couple months. It's very close to a 16-month high, and the 200-day moving average, the weekly equivalent there, is sloping higher. The slope of the moving average is very important, so that's a very good sign. That tells us what's coming after the Fed finishes hiking. So let's circle back and look at some history. 2001, you can see the box there. Gold against the S&P, that bottomed before gold did. Gold bottomed March of 2001, I believe, depending on whether you use the daily, intraday, or weekly. That ratio bottomed, I believe, October, November 2000, and the ratio was above the 200-day moving average, which was sloping up before you really had a confirmed bottom in gold. You did not get that confirmed bottom in gold until really end of 01, or we could say early 2002. So that, end of 2000, early 2001, gold against the S&P was a leading indicator. Look at 2008. Really, in the worst point of the financial crisis, gold declined all the way to 700. I mean, in the summer, I think it was June or July, it made a secondary high around 950. Then it had a sharp decline, really, I think, in less than 4 months, down to 700. But look at the box there. That's when gold strongly outperformed the S&P 500. So that didn't take away the pain that came in September and the beginning of October, but it was a sign of what was ultimately to come. And that was a huge bull market in precious metals and juniors. So very good sign there. Now, the opposite, 2013. Look at the end of 2012. I mean, we can see that at the end of 2012, the very end of 2012, or the first week or two of 2013, that is when gold against the S&P broke down, and it made a lower low. And so that happened 2 or 3 months before gold broke below the 1570 or 1550, whatever it was, that level of support. Gold against the S&P, and prior to that, when gold had the secondary rally to 1800, it went back above the 200-day. Only for a week or two, gold was able to surpass the 200-day, gold versus the S&P. But, the 200-day moving average was sloping downward. So, and, you go back to that time in 2013, that was months before the stock market was getting ready to make a 13-year breakout. So now we have It's different now. Gold's outperforming the S&P. The ratio is rising. Gold is in the big picture, not this month or next, but in the big picture, it's on the cusp of a hugely significant breakout. Stock market is in a bear market, probably the start of a secular bear. So everything is aligning. This leading indicator looks good. This is also a good sign here that gold, in the face of some negative fundamentals, is holding up really well. And that's where we're at. I mean, I think it's not going to be that much time until things really turn. Watch out for the Fed. They might do another hike, but, the economy, with each passing week, there's going to be more and more concern about recession, growth in the economy, debt deflation. And when that happens, inflation is going to be coming down. The Fed is going to cut. Gold will rebound and break out. Let me know what you think in the comments. Really appreciate your thoughts, and I look forward to doing another video for you guys in the days ahead.